everyone, it is Evan here from the Trade Risk on Friday, July 13th, here with a weekend market recap video. We're going to cover all the major markets, the current market environment, and then finish off looking at some sector analysis. Thanks so much for tuning in and watching. Hopefully you guys had a good week trading. Let's jump into the charts here with the S&P 500 cash market weekly time frame. This was the highest closing week since January of this year. So we closed right above that nice round, psychologically important and closely watched 2,800 level in the S&P 500 this Friday, finishing up 1.5% on the week and right at this week's high. So if we zoom out here, you can see we did close all the way back to this bar right here. This was January the 26th of earlier this year. That was the last time we were north of this level. We had the big fallout, this abrupt sort of pullback on the first week of February that closed us all the way back down to 2764, and we've essentially struggled to get a close above 2800 since that time. So for the weekly time frame here, we got a really kind of a picture perfect follow through week. Last week was the reversal week back to the upside, clearing above some short-term resistance at 2740. It was on lighter volume because we did have that holiday shortened week, but we followed it up. The bulls followed it up with more progress to the upside, tacking on that extra 1.5% to the upside. We didn't falter. We didn't give this right back just because it was light volume. You know, we didn't roll right back over. Those are all constructive signs. Now looking ahead, as we come into earnings season, we want to see how the market handles this 2,800 level. We did close above it here on a weekly basis. That is key. That's important. That's what I like to see. But we are still in the vicinity here of this resistance. And because it is closely watched, this is a topic or a discussion that we had in our midweek video on Tuesday, that when markets approach these widely watched levels, it's generally not as clean as many would hope. In other words, we don't just get a clean breakthrough or rollover at that level. Sometimes there's chop, sometimes there's some dancing around and some indecision that the market likes to create, that uncertainty that everybody hates. So that is something we want to be aware of heading into next week. We want to just see if, again, we can get more follow through, if we can hold on to these gains. Make sure, just most importantly, the way I like to think about it or frame it is we just don't want to see a sudden sharp reversal or thrust away from this level. So we don't want to come in Monday morning to a nasty gap down on high volume. We want to stay at these levels. We want to let the moving averages catch up. We can go sideways, that's fine, but we just don't want to abruptly start selling off at a key level like a 2,800. So as it stands, intermediate trend is right on track to the upside here. Bullishly aligned moving averages and price extending north of them. Let's go down to a daily chart now. We can see what we did this week. It was really, we had just one tricky day, and one tricky day is enough to really keep people on their toes, but it was Wednesday of this week. Wednesday we had what I would consider a fairly abrupt session to the downside. The volume wasn't all that high, but we did see a move, a kind of a sharp move off of these highs here. So really, as we approach 2,800 on this first test, as we approached these June highs or slightly eclipsed them and came into this 2,800 on Tuesday, we saw a gap down and really no fill of that gap. Sellers were kind of in control here on Wednesday for most of the session, but very importantly, no follow through, and that is key, and you know, that is a recurring theme in this market. This is a day that would probably keep many traders honest. I believe, you know, we were stopped out of some things here on Wednesday, if I'm not mistaken, and this would probably keep new long, you know, if you're an active trader, you're probably hesitant to put on aggressive new longs right here, and that that proved to really, though, be the extent of the pullback. We didn't actually get any follow through to this move. In fact, we got the exact opposite. We saw a gap higher the next day, and then we proceeded to take out Wednesday's highs and then even Tuesday's highs here in the S&P 500. So that really kind of changed the course and the tempo of this market and really told you that the bulls were kind of back in control, at least in the short and intermediate term. So as it stands for the S&P 500, this area right here, that's where we're closing this week. I'm still paying attention here. I don't want to claim a complete victory, but it is still tough to want to fight this market. I still don't see many reasons to be short here based on all of the technical evidence that we have. That could quickly change. Again, if we saw a move like this Wednesday happen Monday, but then start to get follow through, that would be, that could be the quick start to a downdraft. But until and if that happens, we do want to remain at least cautiously optimistic here and potentially even, fully optimistic, so long as we are closing above some of these fast moving averages and holding up in this trend. So 2800, this general area, that's what I'm paying attention to. Last Wednesday now, the lows here are just a good line in the sand. So if you're a bull, you want to be, you want to kind of keep 2 feet in the door here, participating on the upside. This low from Wednesday, 2770, that is a good line in the sand there. If we start taking that out, use that as your higher low, your pivot high, however you want to think about it. But I think that's a reasonable spot now to base some risk against. So I think that is mostly what I wanted to say there for the S&P 500. We had earnings season kick off with some financials here, some of the very, very big banks on Friday. We'll talk about financials a little bit later. So market kind of digesting those earnings and heading into a busier earnings week over the next couple of weeks there. Markets going on basically full steam ahead. So that is the S&P 500. Let's talk about the Russell 2000 because this is an interesting market. This closed red this week. And, when we look across the major averages here, we had the S&P 500 firmly in the green, not even quietly or meekly in the green. This was 1.5% to the upside. NASDAQ 100 was 2.25% to the upside. Dow Jones 2.3% to the upside. And now we have the Russell 2000, which did not manage to close green. It closed 0.5% to the downside and much closer to the lows of the week than it did to the highs of the week. Now, again, I don't think at this point, though, we need to throw our arms up and say this rally is derailed, but it is something to pay attention to. The Russell 2000 had been the leader for the past several months for this market, and now, again, you can see, even though it had a down week, there really isn't a whole lot of technical damage here. It is still holding above this upper level line in the sand that we talked about on Tuesday's video at 167. So to me, it is healthy digestion here. We again don't want to see an abrupt kind of takedown, a loss of this support on heavier volume distribution days, as it is commonly referred to. That is something that we want to be aware of and just keep our eye out. But for now, the Russell 2000 is a little reluctant up here. It's had a hell of a run, so let's not get too critical of it just yet. But there is certainly, at least in the short term here, a changing of the guard of what's leading this market higher and what's participating. So for the Russell 2000, highs here at 170. Again, we are, as it stands, a 1.5% away from all-time highs. So that could happen in one session. So let's, again, let's keep everything in perspective, but let's just be aware and let's be cognizant of the fact that this did fall into the bottom of the relative performance basis this week. Go to the NASDAQ 100, as we talked about. This is probably, this is the bright spot, not probably, this is definitely the bright spot this week. 2.25% to the upside and breaking out to new all-time highs here, doing it in a very clean sort of fashion. It got this nice move higher last Friday, which ignited this kind of moved back to the upside. It danced around just under these prior highs here, and then it ignited on Thursday and held in there on Friday. So for the Qs here, short-term active level, look at Thursday's lows, 177. These are the prior highs here from June. If we abruptly lose 177 in change, that's when I would at least, you know, in the very short term, call this market neutral, or maybe a false breakout, or maybe there's some you know, shenanigans to start here. But for now, bulls are in control. And this is certainly the bright spot as we head into earnings. A lot of those big tech FANG names are just powering higher ahead of the reports later this month. So that is the market recap overall. Bull's paradise continuing higher. Let's not get complacent. Let's still be aware of the levels. Let's always manage risk and understand where the market has come from. But for now, bulls do continue to dominate. So let us go to some of the other major markets here. We'll go to TLT next, which again is rallying on the week, or holding flat. So it didn't quite get the rally. It rallied into the end of the week here, but again, you know, something that is a little interesting is when we have equity markets that are continuing to move to the upside, and we also have the long bond now also continuing to sort of participate, or at least hold ground. It's not selling off in some type of you know, in some type of left for dead for risky assets. It is still kind of holding up, and TLT is, you know, generally thought of as a safe haven asset. It is holding up. There's a lot of factors that go into it, and I'm not going to pretend to know some of the economic drivers, or really to try and make an inferred guess of what's influencing this at this time. All I know is from a price action perspective, it is holding resilient. It is holding at the top end of a very kind of important prior long-term influential level here. This was support for really all of 2017, this 123 level, and you can see it's just challenging it. There's a lot of overhead supply that's in dip buyers that got caught kind of buying in here throughout 2017. So the market's testing it, it's holding up, it's staying resilient, and for now the short-term trend does remain higher. So be interesting to see if this does you know, decide to roll over and break this upper level, this shorter trend line, or if this can ignite higher and start to move back towards the year-to-date highs here in TLT. So at a bit of an inflection point, but for me, I'm not too interested in playing that one way or the other right now. USO, go to oil next. You can see here, did finish the week down 3.25%. This had a very sort of abrupt session here. This was Wednesday. This helped fuel some of the sell-off there in the broad market, but we saw oil 5% to the downside here, cracking back below this 1470 level. On Tuesday's video, we talked about this as being a level to pay attention to. This was the highs here from May, and we did break back below them. So whenever we have a breakout of a prior pivot or a prior high, if we suddenly lose that, this is kind of the sharp reversal. This is the change of character type of day that I want to be, you know, paying attention to, and USO demonstrated that very clearly here on Wednesday. So for me, this is in a you know, in a cautious area for me. The longer we hold below, say 1475 or so, the more pessimistic, or the more chance I would call this market of kind of making a second leg lower. It is in a longer term uptrend, so this is more for the shorter term tactical traders, but until and if we start reclaiming 1475 or so, I want to be a little bit cautious here on getting aggressively long on the USO. UNG, natural gas here. Weekly chart, 3.25% to the downside. This is really, you know, started to roll over back in June, about the second half of June. Actually, really coming into July is when we started to get the breakdown. I guess it was the first week of July, and it's really been in a tough spot since. The moving averages kind of tell you everything here. Bearishly aligned. They're hammering back above price, and they're coming down, hammering against price, that is. So sellers in control here. Don't see that changing. Volume's not heavy on the sell-off. I guess that's the only thing that is I don't know if that's interesting. I don't know if that, you know, that's generally either not a good thing, that it's just methodically kind of selling off here. That shows like it's a very steady distribution at this point. We're not seeing any high capitulation at this time, at least not in the UNG ETF here. So for now, sellers in control, not really interesting to me whatsoever, until and if we start breaking back above 2340 or so, then you know, that would be enough proof that maybe the tides have shifted enough there in natural gas. Gold also suffering some more losses this week, 1% to the downside. You know, it finally had this turnaround week last week. It just reversed the selling pressure, didn't even really add any gains last week, but now you can see sellers back at it, falling back to last week's lows. So gold continues to remain under pressure here. Trend is lower. Don't see that changing at this point. Maybe some type of double bottom reaction off of last week's lows. If you're real tactical, I could see the snapback or the reversal play you could make there, but for me, not so interesting. And silver also back to last week's lows, still holding below this multi-month support level at 1530. As I've said multiple times in the past couple of videos, really it's a seller's market here until and if this can reclaim 1530. So I'm interested if it can see a sudden reversal to the upside, but I certainly don't expect it to at this time. So if it does, great, that might give us a nice trade, but for now, sellers do remain in control. So those are the major markets. Let's go through some of the sectors from this week. We like to sort based on the weekly performance. We'll take a look at the top three and bottom three. On the top of the list this week is the industrial ETF. This is XLI. If we go to the weekly chart here, you can see a much needed sort of rebound here. Did come on some slightly higher volume, but XLI had been beaten up. It was hanging out near the lows of the year. This is one of the more vulnerable spots of the market. So it is nice to see the recovery, and this speaks to some of the rotation that we're seeing. The small cap stocks like the Russell 2000 kind of taking a backseat this week, and we really see some of the industrials, the Dow Jones, some of the bigger cap names really starting to see some rotation or at least get a little bit of a bounce right now, and that's what we're seeing here in the XLI. So still in a tough spot. I mean, it's still structurally not that inspiring. If you want to shoot against last week's lows, that makes sense, but for now we're still kind of in a messier, loose range here. So for me, XLI, maybe the individual components would be a little more interesting. The ETF outright, not so interesting to me. Technology, also in the top three this week, 2% to the upside, breaking out to new highs, just like the NASDAQ 100. XLK here making a move higher, so that looks positive and constructive for the market. And the discretionary ETF, so a pretty powerful combination of the top three. We get industrials, technology, and discretionary all breaking out, and discretionary also breaking out to new highs. You can thank Amazon for that. And if you were to look at number 4, it would be biotech. So really a nice kind of risk appetite to the top of the basket there on the relative performers. And then when we go down to the underperformers of this week, things that were red on the week, first was utilities. So we finished down minus 1.18% here. This was marching higher. This had a nice multi-week run. So a little bit of a pullback here I think is healthy, and it kind of sets the chart back up for a potential continuation higher, but it was the bottom performer this week. Basic materials also in the bottom half here, just managed to close slightly green on the week. Pretty messy pattern here as well. Lots of kind of things going on in this chart. I need to really kind of redraw what's going on here, but all in all, it's just it's a choppy kind of sideways range. I don't really want to make anything more than probably this box here, just a kind of a chop suey chart moving sideways, and we're smack in the middle of that range. So to me, really not that interesting, or not a space to really be paying attention to at this point based on the way I look at markets. And then energy did finish higher on the week, almost 1%, but still kind of in a smaller range in itself. It is still just kind of moving sideways here. Hasn't hasn't gotten enough momentum. If we can start to clear definitively back above, call it 77 3/4 or so, that might give us the momentum to trigger the signal to start allocating back into those energy names. Some of the individual components though are holding up better than others. I've seen a couple of these fall into some of the momentum scans that I run, so it's definitely still a mixed bag here. You're going to find some leaders and laggards, but XLE as a whole, bottom quadrant of this week's performers. So that is what I have for this week's video. Thanks so much as always for watching. If you do like the videos, do subscribe on our YouTube channel, and you can stay up to date with all of the latest that we publish. So have a great weekend and hope to see you back here next week.